Hello, welcome back. Let's move on to chapter 4, clip number 3, slides 21 through 28. So let's look at bond market indexes. Bond market indexes. All right, so first of all, why have one? Well, the same reasons why we want to have an index for the stock market. One, the need for a performance benchmark. How are we doing? It gives money managers something they can use to create a product to sell, okay, an index fund. It is much more difficult, and I would also say once again that we need to have an assessment of how the market's doing. That's why we need one. That's not even on there. I'm going to have to add that on there. Man, what am I thinking? All right. It is much more difficult to create a bond index than it is for a stock index. Why is that? Well, it's because the universe of bonds is very broad. There are many more bonds outstanding than there are stocks outstanding. There are approximately 5,000 stocks that actively trade in the United States, and really out of those 5,000, you can really cut it back about 1,500. There are really only about 3,500 stocks that are significant and meaningful that trade in the United States. And many more bonds, 10 times that number of bonds, maybe 50 times that number of bonds. So many more bonds, so it's much tougher to get a handle on the universe because bond maturities constantly change. Remember that a bond that was issued a year ago that had a 10-year maturity is now a 9-year bond. So maturities change constantly. Okay, so once again, it's hard to get a handle on all the bonds that are out there. Pricing for bonds is much less accurate than it is for stocks because many bonds trade very infrequently. There's not a lot of liquidity, and there is a large spread between the bid and ask prices. So it's really tough if you want to understand what a bond is worth. Most bonds trade over the counter. You have to go to 4 or 5 trading desks to get a bid and an ask to determine what a bond really is worth. A bond has its theoretical price based on interest rates and time frames, but it also has its market price. All right, so who maintains bond indexes? Well, Bank of America, which owns Merrill Lynch. Bank of America bought Merrill Lynch, which was a large brokerage firm, and Merrill Lynch had bond indexes, so now Bank of America Merrill Lynch has many bond indexes. Citigroup, which is another large bank, well, they bought Salomon Brothers, which was also a large investment firm, and so they have their bond indexes. Barclays, which is a foreign bank, they bought Lehman Brothers, which is a large investment firm, and so they have their indexes. I think I'm seeing a pattern here. Okay, JP Morgan, a large bank in New York. And then Bloomberg, if you don't know Michael Bloomberg, the mayor of New York, he made his billions by starting a database and a quotation system that he named after himself, the Bloomberg Company. And so they maintain indexes. And then Standard & Poor's, which is owned by McGraw-Hill, they have stock indexes and they have bond indexes. Okay, various countries. So that's bond indexes. I used to have more information about it, but I took a lot of it off because they're just it's meaningless, to be honest with you. If you want to do some more research on bond indexes, you can. All right, so there are global equity indexes out there as well, and various countries use their own unique index. So it's helpful to have one firm measure each market and create standard procedures, so that we investors and academics can use the same procedures and metrics to understand how these markets are performing, okay? So we can compare markets. All right, so EAFE, the EAFE index. It's an acronym, EAFE, Europe, Africa, and the Far East, operated by Morgan Stanley, which is a large investment firm. This index tracks stocks in developed markets, developed economies outside of North America, including, I said Africa, I meant Australia, Europe, Australia, and the Far East. Okay, so Asia. Europe and Asia. And then we have the EEM, which is also operated by Morgan Stanley. And this index tracks 2,600 stocks in 23 less developed markets. Just got an alert that the U.S. stock market just closed. All right, it's 3 o'clock Central Standard Time. So EEM, so we have IFA, which tracks stocks from developed foreign markets, and then we have the EEM, which tracks stocks in less developed markets. Okay. Then we have the Financial Times World Index. The Financial Times is a London-based financial newspaper. It's the UK equivalent of our Wall Street Journal. Okay, and so they cover 2,400 equities in 23 countries. So it's an international index. And performance is stated in various exchange rates, various currencies. Okay. All right. Then we have what's called a composite stock bond index. So if you have what we call a balanced portfolio, which is a portfolio that has stocks and bonds in it, then you'll want to take a look at the composite stock bond index to use as a benchmark. Okay? This type of index measures the performance of all securities in a given country. Okay? So it makes it possible to compare returns and correlations in financial markets for a variety of countries. Okay? Then we have the Merrill Lynch Wilshire. Remember, there's the Wilshire 5000. And Merrill Lynch has their indexes, capital markets indexes, and it looks at 10,000 securities, stocks and bonds. So this is a very, very broad index. Okay? Let's take a look. Let's see how far we're supposed to go here. Through slide 28. So we have 2 more slides to go. Let's look at correlations among securities and their price changes. This is really important stuff. The U.S. stock market. The U.S. stock markets are highly correlated with each other, which means that large cap, mid cap, small cap all tend to kind of move in the same direction, but the magnitude is very different. Growth and value tend to kind of move in the same direction, but the magnitude. Although the American Stock Exchange is not as correlated with the New York Stock Exchange or the over-the-counter markets, because it is very concentrated, the American Stock Exchange is, in the energy sector. A lot of energy stocks. U.S. stocks have low correlation with foreign markets, particularly Asia. Okay? This confirms diversification benefits. Remember that any security or investment that has a correlation of less than 1 adds diversification benefits. Okay? U.S. bond prices are all highly correlated with each other because they all respond to the same systemic macroeconomic variables, and these would be the risk-free rate. So they all respond to what the Federal Reserve is doing. They all respond to demographics, and they all respond to inflation. Okay? So here is a chart of correlation. And hopefully you can get a quick, a good look at this. And then we have the long term. So we have large cap U.S., IFA, emerging markets, bonds, junk bonds, municipal bonds, currencies. I can't remember what this is. These are commodities, REITs, hedge funds, and private equity.